Welcome to Premium Cash Flow Real Estate Investing Podcast with SK057. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK057, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK057.
Welcome to another edition of Premium Cash Flow Podcast. Today, I have the pleasure of hosting Pancham Gupta at our show. Thank you for your time, Pancham. I appreciate it.
No, thank you for having me, Sakar.
Absolutely. For viewers who may not have heard of Pancham, he is a very famous multifamily investor. Their company, Mesos Capital, has several assets in different states from North Carolina, Georgia, Florida. And we are going to, learn more about his story today and learn a lot more basics and some nuances of multifamily business. So thank you for your time, Pancham. Kindly help us get started with your, just the background and how you kind of came about into multifamily.
Sure. So I actually came to US in 2003 to get my master's degree in computer science. And the idea at the time was that I'll work here for a few years and I moved back to India and I really wanted to go back. So that was the idea. And in 2009, we sold everything and, decided that we'll move back. But we found out that, we're expecting our first baby. And we bought everything back. We decided, it's hard to move cities when at that kind of juncture. So, why move even countries, right? So then everything changed. After that, we decided in 2012 that we'll stay in this country, and I started investing here just on the side to buy single family houses, and slowly it mushroomed into 5 different states. I had duplexes, triplexes over 5 different states, and realized that it was I was having so much fun, but it was not very scalable. And this hobby of mine suddenly became addiction, and then it became passion for me. And I decided that there should be more easier way to scale the business, and start looking into multifamily and syndications, and really liked the path that it provided. So I started looking into that, and we did our first deal, then the second, then the third, and the fourth, and that's how I, kind of grew into multifamily and multifamily syndications. And since then, I've sold most of my properties that I personally owned in my portfolio, and I primarily focus on multifamily now.
That's awesome. And if I may, Pancham, how did you decide to sort of turn into real estate? Like, why purchase the properties? What was appealing about real estate? And why not just continue the normal W-2 job and build a retirement base and things like that? What was it about real estate that you really wanted to divert towards that?
So there are 2 actual points on that. One thing that I always go back to this book, Rich Dad Poor Dad, and the Cash Flow Quadrant. I read it around the same time.
Interesting.
And so it really resonated with me. So that was one reason. Second reason was that my parents in India, they also invest in real estate. Their motivation is completely different. The way they make money there is completely different the way you do it here. But I had seen my dad growing up, doing these deals. And so it naturally resonated with me. And with that book, I was like, what, let's start exploring this field. And, I slowly started spending all my weekends going to open houses near my house. And so I actually bought 2 rental properties before I bought my own house.
Very interesting, and it's kind of very analogous to my story as well, Pancham. As you describe, I can almost hear that. Isn't it something that I typically say as well? Like, I mean, as I kind of share all the time that I was the same way. I was still living in apartments, and I clearly remember I had 6 or 7 rental properties even before I had bought my first house at the time. And a similar story, exactly. Like the only difference is that I scaled my portfolio locally in Baltimore, where I think today we have over 200 properties. But that's what kept me going. And I can share with you all as well is that I think when you have sort of multiple properties in multiple states, just the management aspect of it becomes difficult, right? And
Very
that's where
difficult.
I think the efficiency and the scale of multifamily comes in. And here, like I always like to point out that, like here I in Baltimore, I have my own portfolio. Everything is here, like we are vertically integrated, so it doesn't feel as much painful. But I absolutely share your sort of sentiment where where you have multiple properties in different states, and that can start to become a challenge because it's just not scalable. The cash flow perhaps sometimes can be very sort of up and down. So Pancham, help us understand how did your first deal came about, like, when you started into multifamily?
So our first deal, a little bit of history there. So I had these properties in 5 states, right?
Sure. Mhm.
And I had built these relationships with people, with brokers in these states, mainly for single family houses or
Mhm.
small properties. And so I was talking to all these brokers saying that, you know what, I want to scale up and, give me deals that you have for multifamily. But then we were also traveling, that I was traveling and meeting these new brokers who
Mhm.
are primarily focused on multifamily. And so one day we were in Charlotte and looking at some multifamily deals, and this email comes about, and we were like, okay, it's a 44 unit property in Charlotte, near downtown. And we look at it, we really like, we drive through that property, even though we never spoke to the broker around that time, and we liked it, and we called the broker and we're like, you know what, we like this. That's how we actually found it, through
Mhm.
like becoming part of their email list and connecting with them, and kind of came to us. It was not listed, but it went through every single one who was on their list.
Sure, sure. So now help us understand, Pancham, that there are a lot of new and wannabe investors who are listening a lot of times to podcasts, and I want to understand that what would be some of the steps they can take to kind of get foot in the door in multifamily. Like, what would you like? A lot of listeners many a times will share with me that, oh, I went to this boot camp or I did a 1 day workshop, but I'm a little confused as to what different steps I should be doing to actually, sort of start doing the deals and things like that. Can you maybe, since you've been through this, give us share some steps as to what are some of the things like a new person should do for getting started with multifamily?
Sure. So, like you mentioned, that going to boot camps and all that, that helps with the education side of things, right?
Sure. Mhm.
And education, again, there's a very good place. I have many, many coaches, and I'm pretty bullish on education. But at the end of the day, education can only help you so much, right? Everyone
Sure.
knows that going to gym is good, but at the end of the day, you have to take action and go and do the
Absolutely.
workout, right? So same
Sure.
thing applies here, that once you learn that, you have to go and hit the pavement and go and talk to these brokers. And the way I would say is that most of the markets, right, in our experience, the top 5 to 6 brokers control 80 to 90% of the entire multifamily market in those, what, pick any city, right? Unless
Sure.
it's a
Mhm.
huge city, you would see that pretty much that's the case. So I would say, go find those list of brokers, which should be very easy to find, either through the local contacts, and you can find that list, and then start talking to them. You have to go and spend time looking at the deals that they are putting out. So that's what we did. We were flying to these places, even though we were not buying at the time. I would go and check out all these deals, talk to these brokers, and spend time, and so
Mhm.
that they know us. And there are some brokers even today, and it's been like 5 years now, that we have not bought even a single deal. feels embarrassing actually when I talk about this, but the thing is that we have been on their list and they know us so well. And we have been in best and final many times. It's just that we always got outbeaten for whatever reason.
Sure.
And but that's the way. I would say there's no easy cookie cutter answer to that. I would like pick the list of brokers and go start meeting them. And the number one easy way to meet them is actually go tour their deals, because they would be more than happy to show you the deals.
Sure. And that personalized visit and, like walking the properties that's kind of starts your relationship, and brokers can say that, okay, yes, this group of individuals is definitely interested, and that brings more credibility to your group. Would you agree?
No, 100%. So see, if you do it once, they would kind of remember you. But if you do it like 10 times in over span of, let's say, 1, 2, 3, 4 years, the 11th time they would know you. There's no like, there is a deal that came almost 2, 3 months ago, and we have never bought a deal from this guy, but he picks up my phone, talks to me, spends a lot of time, and because he knows me, I've
Sure.
spent so much time, gave him feedback, and we've been in best and final, never won a deal, but still they know that we are very interested, and they know that we are doing deals in the same markets
Sure.
because we have closed.
Absolutely. And it's all about, once you have one deal in that market, brokers will definitely sort of put emphasis that, yes, I know Pancham and his group, that they have closed XYZ a deal, and their group is serious about acquiring more and more assets. So awesome. Now Pancham, help us understand that as someone is like touring the properties and looking at these deals, right? Help us some understand like a high level, some underlying underwriting principles that, okay, typically when you are seeing a broker's operating memorandum, right? If you want to, like, let's say, analyze the deal like preliminarily, I'm not talking even like the detailed underwriting, but let's say a deal comes to your desk, what are some of the things that preliminarily you go through that, okay, whether it's the cost or the age, give us some sense of how you vet a deal on its surface without spending too much time in it.
Okay, so we have a very, like, we have a checklist of like 10 to 15 items that all the filters, so to speak,
Sure.
the deal has to go through. You
Mhm.
mentioned a few already, like what time it was, like what's the year of construction, right?
Sure.
So we actually go through that list, and actually while talking to you I'm trying to pull that up, but basically we have year of construction. We don't look at any deal which is before 1985 or after 2005. It has to be more than 100 units. It has to have pitch roofs. It has to have uh, uh, no chiller. It should not have chiller system on it.
Sure.
Right? And then we have median income in that location has to be $40,000. It has to be close to some of the retail that we have in our list.
Mhm.
So there are these checklist of items that we go through, and if it doesn't fit any of that criteria,
Mhm.
the deal loses the weightage already. Now, most of the times we won't even move to the second step.
Sure.
Then, if it falls within those categories, then we will start looking at, okay, what's the average rent on this one, right?
Mhm.
We have a criteria on that too. If the average rent is less than $700 or $750 per unit, we won't even look at the deal, right?
Sure.
And
Mhm.
and then we start looking at how much is the deferred maintenance on the property. Like, what is the broker saying? Usually it's always incorrect, like or not incorrect, but you have to dig deeper to really find out what the deferred maintenance is.
Sure.
So that's when we start looking into the numbers. We will open the T12, like trailing 12 months numbers, and look at the P&L, and start looking at the underwriting, like start to do the underwriting in our
Sure.
basic templates that we have.
Mhm.
And so yeah, does that answer your question in terms
It
of?
does, it does. And I was just going to follow up. They're also saying that, obviously we talk about the growing cities or the robust submarkets, as we call it, right?
Mhm.
And you just shared, Pancham, there that you don't look at deals where the average rent is below 700, 750, right? So I would equate that to perhaps kind of a thinking strategy of yours, that you may be thinking that, hey, maybe if the rent is below 700 or 750, maybe the area is not that great, or perhaps it may be a distressed sort of location. Give us some thinking about why you're saying that the rent below 700, 750 may not be an optimal sort of candidate for you.
No, that's a good question. So I'll tell you, this is based off the experience.
Sure.
Okay, this is the category. This particular criteria that we put out is because of the experience that we've had. Yeah, you can say that the rent can kind of tell you what kind of area it is, right?
Sure.
So for the area, we do have the something called median household income in that particular location. We can find that out within 1 mile radius, and if it is less than $40,000, then the likelihood of having 700 average rent is very high. Less than
Sure.
700 rent is very
Mhm.
high. But if the median income is more than 40,000, then if the rent is lower than that, then potentially there is a lot of room to grow on the rent. So yes, you're
Sure.
right, but it's not always the case, because you
Sure.
always have, pockets of, bad locations. But our thought process is that, when the rent bill goes below that number, the the kind of tenant class that it attracts
Mhm.
is is not like, they don't have enough money to, they're not prudent financially,
Sure.
like less prudent, I should say.
Sure. Sure.
And if they, for example, if their iPhone breaks, they potentially would not have money to pay for the next month's rent, right? Because
Sure.
they have
Sure.
now
Sure.
just repaired their iPhone. So this is a very gross generalization,
Sure.
but I would say that that criteria came through based on the experience, that
Sure.
it's harder to improve and turn around the asset if you have uh, people who are paying less than, let's say, 700 to 750,000, $750 rent. So if you really look at it, we have 3 times the criteria on rent, right? So
Mhm.
700 times 3 is 2100.
Sure.
2100 times 12 is, around 25, 26,000, which
Sure.
is way below our 40,000 median household
Benchmark.
income
Correct. Correct.
criteria. So yeah, like I would say what your correlation was, it kind of holds true. But this is what our experience is, and most of our portfolio, the average rent is actually less than, so more than $850.
Sure, sure. Thank you for pointing that out. And this is where your experience and the practical value comes in. And thank you for sharing that, Pancham. And viewers and listeners of the podcast can definitely, go just Google a medium household income within that neighborhood, find out, what the income is or what the average value of houses are also in that neighborhood, just to understand the neighborhood dynamics. And as Pancham rightfully pointed out, that as lower the income goes, you're almost like one sort of mishap away from, either it's a car repair or some type of a household financial struggle, and boom, you are into default, right? And so thank you for sharing that, Pancham. Also, Pancham, like talking about sort of the value add and sort of the promise of the asset, and you give returns to the investors and things like that, right? So many a times nowadays, we see brokers who are giving us the operating memorandums where value add seems to be the new buzzword, right? So sometimes value add can be, oh, there is a lot of deferred maintenance, or a good value add can be is that, oh, the owner has sort of owned this property for too long, but hasn't done the the interior or the cosmetic improvements that can give you that the rent bumps and things like that. So where I'm going with this question, Pancham, is that when you see the operating memorandum, right, how can an investor know that okay, what is the right candidate to pick? And you don't want to pick a value add project that is like extremely distressed. Maybe a plumbing is bad, or perhaps a roof may be going away and things like that. Share some of your experience around those points, please.
Yeah. So, in other words, what you're asking is like, I'm going to rephrase your question that
Sure. Mm-hmm.
the value add could be of different, types, right?
Sure.
One is like you're taking care of the deferred maintenance. For
Sure.
example, changing the pipes on a building or changing the roofs
Sure.
does not really add to your income.
Sure. They're more
Changing the
like CapEx type of items.
Right. So changing the pipes sometimes does add to your income because there could be very old pipes on the property. We have lived this, and there could, because of that, there could be a lot of underground leaks that you would not even know, and
Notice.
because of that, the water bill is very, very high.
Sure.
And if you change the pipes, yes, your water bill goes lower, and because of that, your income goes higher. So yes, there are you can have that, but so that's one category where you're actually really taking care of deferred maintenance, right? Which
Sure.
is not really adding to the bottom line. So that's one. And second is the kind of value add that you can do. For example, you can start charging people for utilities, right? Or you can start charging them for parking space, or you can start charging them for trash that they are doing, or you can go in and improve the units and see how much of a rent bump you can get based on what the location and the property can demand, right?
Sure.
So for us to really see, when you see this offering memorandum and they say this buzzword like value add, you really have to dig deep and you have to figure out whether that area demands that kind of renovation, number one.
Mm-hmm.
And if it does, how much rent bumps it can get. Because you can go in a location and really do all this value add, but the location, supply, demand, parameters, the supply and demand relationship may not even fetch you that kind of rent. Yeah, you can spend enough money, right? So yeah, it's very, very important to really know that location and what it can fetch. And what we do, we actually physically drive to every single comp around that property and look at the competition, see the units, see what they have done, and see what kind of rents they are fetching and what kind of occupancy levels they have. And based on that, we come to a conclusion of, so that's the practical side where we actually physically, you have to believe your eyes and you have to go physically see, right? That's the practical side. Then you have the data side, right? You get the CoStar reports, you get the, all these reports, and then you kind of see if they tie out or not, right? And then you have to figure out whether the value add makes sense or not.
Awesome. Thank you for that practical insight, Pancham. Now, coming to structuring the deals, Pancham, how are you like structuring the deals between your sort of general partnership and also the limited or the passive investors? Give us a sense of what returns you give in your deals.
Yeah, sure. So we do a preferred interest rate, like a preferred rate model where we give out 7 to 8% preferred return. And then we do, 70-30 split, where 70% profit sharing owned by the investors and 30% on the general partners side. And then we have three kinds of fees that we charge. One is the acquisition fee, which is 2% of the purchase price. Second is the disposition fee, which could be, which is 1% on the sale side. And then third is the 2% of the gross rents, which is the asset management fee, which we charge. And we actually let go of that fee if we do not meet the pref.
Sure, sure. Makes sense. Makes sense. Thank you. And also, Pancham, speaking of, your group has done a few deals into full cycle, right? Give us some sort of tidbits about how, you acquired the deals, what sort of, rent premiums or value adds you did, and what were the return parameters and how you exited the deals within how much sort of years.
Yeah, sure. I can give you everything. This is actually the same deal. We can discuss the very first deal we did, Charlotte deal,
Sure,
44
sure.
units, which I discussed earlier. So we bought it for $2 million, that deal, and we raised $781,000 for it, and we put a majority of our money also in there, like 200,000 was our own, and and then we sold it for $3 million
Mhm,
within 23 months actually, and we gave out around 27% IRR to our investors on that deal. So our goal was to go in and increase the rents and also take care of some of the deferred maintenance that we found during the due diligence phase. For
mhm,
example, the structuring was a problem on one of the buildings. We fixed that,
mhm,
and we had to build trench. There were some water issues. We fixed those, and then we also bumped the rents. It was very close to Charlotte downtown, like almost 3 miles from the Bofa Stadium where Carolina Panthers play.
mhm,
So first bus stop from that location. It was so we the units were very small, but we were able to fetch the rents that we were underwriting.
mhm.
We underwrote,
Sure.
and so we were able to sell it for $3 million, and that's what we did, and give
Awesome.
our
Awesome.
26% IRR.
Thank you. Thank you. And also, Pancham, like talking about submarkets and sort of the growth that it gives, share some sentiment about why you like to go in growth submarkets, or perhaps how you evaluate these different submarkets based on, where you would want to buy. Like, why not some kind of a declining submarket? Why the, like let's say Charlotte or the Raleigh, or you shared like some of the Florida markets as well, right? What is your sort of thesis around why you want to be in those specific sub-markets?
Yeah, so we look at, again, we have a very long checklist of things that we look at before we pick the markets, and some of those things are like overall job growth, population growth, how is the job diversity. We look at the U-Haul and United Van Line stats and how many one-way rentals were done by the millennials and where they were moving and where the builders are building. And so the reason behind all of that, right, we pick after it checks out all of these boxes. The reason we pick these markets is that if there is a downturn,
Mhm.
which seems likely now,
Sure.
right, with the recession and all that.
Right.
So if there is a downturn, these markets will be the last one to see the impact of that, compared to
Sure.
some of the markets which are single player. For example, Detroit, which was automobile industry.
Sure.
um, these will be the last ones to get impacted and would be the first ones to come out of it,
Sure.
right?
Mhm, mhm.
That's our thesis behind it. And if you're going in the markets which are declining in population, or there is no job diversity, you're basically trying to catch a falling knife, right? Yeah, it may
Absolutely.
not happen right away, but it will at some point. You're basically playing with fire.
Absolutely, absolutely. And I also like to many a times also mention additionally there, Pancham, also is that, I think the politics or the leadership plays such a key role into, what sort of business growth you are seeing.
Yeah.
More the business growth, the more the companies are coming, the more the jobs are coming, right? As job creation happens, as you rightfully pointed out, like more in migration, people are coming in. And like a lot of times, as we all say, like, the apartment business is all about multifamily jobs, job creation, and how we can perhaps increase the rents and give more returns. So thank you for sharing that insight, Pancham. I appreciate it. Uh, Please share with our listeners how they can find you and learn more about your company and the projects you're doing.
Sure. So my email is p@thegoldcollarinvestor.com. That's also the name of my podcast, and I talk about different asset classes there.
Sure.
And I have a free report that they can actually download where I actually list out 6 reasons, and my 6 reasons to invest and diversify outside of Wall Street, and also the alternative investing space, like different kinds of investments that you can do. And they can download that at the goldcollarinvestor.com/download.
Sure. Awesome. Thank you for your insights today. I encourage viewers and listeners to check out the free report. As you are rightfully found out, Pancham is a wealth of knowledge. I'm sure his report about different asset classes and why you want to be outside Wall Street. I personally enjoy his podcast as well, where a lot of good investors come on and share their insights. So definitely check out Gold Collar Investor Podcast. And regarding us at Premium Cash Flow as well, thank you for listening. And we also time to time have different opportunities to invest. So if you're looking to invest passively, please register yourself using Invest With Us, where we can jump on a short phone call and understand your goals and see if we can help each other. So it's been a pleasure, Pancham. Thank you for coming on. I look forward to hearing more about you and different projects you're doing in future.
Thank you for having me, Sakar. Take care.
Thank you.
Thanks for listening to Premium Cash Flow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.